Welcome back to the Sprott Money News and SprottMoney.com monthly precious metals projection video. I'm your host, Craig Hemke. Joining us as usual here in the month of May 2022 is Chris Vermeulen of the technicaltraders.com. Chris, good to see you.
Yeah, good to see you, Craig.
Just a reminder as we get started, I know I probably sound like a broken record, but please help Sprott Money spread the word on this content that's produced free of charge for you. It's publicly available. Best thing you can do is to help them spread the word, subscribe maybe, or send out a like on whatever channel you're viewing this. But then, of course, keep Sprott Money in mind. I mean, we're going to be talking about silver prices that are quite a bit lower than they were a month ago and maybe higher by a month from now. So now is a good time to be looking around and doing some shopping. Sprott Money always having great competitive prices. And on silver right now is probably the time to be looking. Gold too. Again, SprottMoney.com. As you can see, Chris has the page up right there. Thank them for this content by sending them some of your business. Go to that site, or of course, call them at 888-861-0775. All right, Chris, it is Monday, May the 9th. It was amazingly just 3 weeks ago that we came out of the Easter holiday, and man, everybody was pumped. Gold was trading briefly over $2,000 an ounce. Silver was about $26.50. And now silver has fallen 15 days in a row since. Talk about a reversal. Yeah. And it's really all markets. The spiking yields here in the U.S. have really wrought havoc everywhere. So let's start there about your management and what you do. Just trying to eliminate some of the downsides so that you've got some dry powder left over to take advantage of these dips.
For sure. I mean, we're coming into a unique time. I mean, bear markets don't happen very often. I mean, they're very rare, but they're also one of the most dangerous things for an investor, especially if you're 40 years or older. You never know how long a bear market's going to last if we get into one, which we are pretty darn close to breaking down into a bear market. And I kind of wanted to show this chart. And this is my investing strategy where really it's all about if you've got like long-term passive capital, there is a time when you really don't want to be in equities. When we do get into a bear market, I mean, there's a lot of opportunity to the downside. But as a very passive investor, avoiding a bear market is one of the most powerful things you could do with the least amount of effort involved. And all you have to do is when we are in a bear market is exit your positions and go to like literally a cash position. And cash can be one of the most powerful plays because as we've seen over the last couple of weeks, when there's panic selling in the stock market, almost nothing goes up. And there isn't a place to dump your money other than really cash. And so I kind of want to let people understand that if we are coming into a bear market, which we are potentially a week or two away, avoiding one of these is going to be the opportunity of a lifetime because a bear market may last, 3, 6, 9 months. It could last 2 or 3 years. And if you're later stages, you've got all your net worth built up, you're in your 50s plus. For all we know, back over here in 2000, it was like 12 years before the SP 500 got back. To break even. That is a long time. For the NASDAQ, it was 18 years. And so, the majority of investors don't have that much time. They don't want to ride and lose down those gains and burn up money at a discounted rate. So I think it's really important to kind of show this. And this is one of the things that I try to do with the Technical Investor newsletter. And what I really want to kind of hone in here is right now is kind of a point for investors. It's not about trying to make as much as you can. It's about trying to preserve your capital. And this chart here, it shows 3 different indexes. The green one here is just trading from a technical standpoint using the technical traders investing strategy. The gray line is the SP 500 and the black line is the overall global stock market. The key here is what does the green line do when a bear market comes? Once we're in a confirmed bear market, you move to cash and you can avoid these huge collapses. There's some opportunities in 2007, 2008, where you can actually generate returns in a bear market, but you're sidestepping these big market collapses. And in the long run, you don't dramatically outperform the indexes, but the key is you're getting rid of or eliminating the drawdowns, the risk, the roller coaster ride, and the years it could take to make your money back. So this to me is one of the most important times in trading. I've been through 2 bear markets, traded through, invested through 2 bear markets, and I mean, if somebody's going to do a play and focus on the markets, now is the time for an investor to actually take action and make sure they have that gunpowder dry, as you said, Craig, because when the market resets and there's a revaluation event, to have all the money you have right now available to dump into growth stocks, gold, silver, miners, all those things when they are primed and ready for a massive move, it's going to be pretty exciting. So that's kind of the key thing I kind of wanted to share is we're in that big perspective, big window time to make a move that can, save you so much money. And a lot of people don't understand that this volatility has got so many people dancing in this market, trading back and forth, and they're just getting slaughtered. This is so dangerous for most traders.
Right.
It's day trader heaven. It's swing trader nightmare because the markets gap up and down 5-6% every day, the swings. So it's kind of luring them in, but it's just chewing them up and spitting them out. And the reality is doing nothing is sometimes the best thing, right?
Right. Well, leave that chart there for a second, because I think you lead into that pretty well. A couple of things. The former head of the New York Fed, Bill Dudley, said about a month ago, I mean, Chris, you've heard, don't fight the Fed, right?
Yeah.
Bill Dudley said the Fed's goal is to inflict more losses on stock investors. So they've told you this is what they want to do. It led me twice in the last month in my weekly column at Sprott Money. You can find it, all these weekly columns linked at Sprott Money, to write what I call concern for stonks. I mean, if the Fed's telling you this is going to happen, you might want to take their word for it. And, the important thing is the math. I mean, if everything falls 20%, it's got to go back up 25% to get back to even. And then if you're in the leveraged ETFs, oh, holy smokes.
Yeah.
They really got a problem. Okay. So in that chart you showed, the breakdown that you have to avoid is when the bottom drops out, when you break down through support. I wanted Chris to put this chart up because what the green line there, this is the S&P 500. That green line is the 200-week moving average. I don't know if that's anything special or not, but you can see how many times in the past 5 or 6 years, this S&P has pulled back and found support that line. Well, the most analogous situation to now is the fourth quarter of 2018. The Fed was talking about hiking rates in 19 and tightening their balance sheet. The 10-year note got to 3.25%, and the stock market plunged. And Chris, if you could highlight 2018 on that chart, you can see there was some support there at about 2,600 on the S&P. And that support held into December, and then down it went. And when it got down to the 200-week moving average, it was about 10% lower at 2,300. That's the Powell pivot. That was a point of max pain. And then they changed policy in 19, gold rallied, everything rallied. Then you can see the next time it pulled back, actually fell below the 200-week moving average. Well, that was COVID. And the total market sees up. Well, what happened? Well, March 20th, here comes the Fed with QE to infinity. Everything takes off again, okay, especially gold and silver. So as you break down through support, look what happened. I mean, the history would suggest you follow that 200-week moving average. And as you put on there, Chris, we're breaking down. You can see the obvious support at 4,100 or so. In the S&P, we're now below there. What do you think of this whole idea that that's how far the stock market could fall at a minimum before we get another Powell pivot?
I think there's pretty good potential. I mean, the amount of fear that we've seen in the stock market in the last several weeks here is pretty big. Just last week alone, we were seeing readings on my panic selling indicator telling us that there was 31 people hitting the market to sell button on the New York Stock Exchange, every one person looking to buy.
Oh God, sounds like silver.
Yeah, it's crazy. And anything over 3 is extreme. So I saw it go up to 31, so 10 times. Typically, when we see this panic selling, it's a great buying opportunity. We usually, I usually point it out to subscribers in the morning. I'm like, this is great. We're going to have a 1 or 3 day bounce. It could be a really big standout bottom looking back a couple of weeks from now. But I was telling them over the last week and a half, I said, listen, there is so much selling and so much fear right now. Too much of a good thing is actually bad. And it's not just an oversold, wave here. We actually have massive herd mentality starting to get bearish. I think there's huge distribution selling going on. And, this bottom could fall out very quick. I mean, it's really only a 1 or 2 weeks away from, hitting that 200-week moving average. It won't take much. And this market just moves so quickly. So you got to be really cautious. about what's going to potentially
And you
happen.
can see there, again, the support that was around 4,100 going back a year, right?
Yeah.
And then from there, if we start, now that we've taken that out, those lows, there's quite a few lows back there in September and October of 2020 near 3,200, which is also where that pretty close or just below where that 200-week moving average is. So
Yeah.
anyway, to your point, we don't talk about the stock market much, but man, when everybody starts getting margin calls, they sell anything that has liquidity.
Yeah.
And you get a drop down there, another 15% in the S&P, that's going to affect everything. And as you said, Chris, if you can avoid that, because probably everybody watching this has 401k, an IRA that has, regular mutual funds in it or something like that. This is a time you really got to be paying attention because go ahead.
For sure. The other thing too, Craig, is you go and you look at you go look at bonds. I mean, most people are pretty heavy in bonds. I mean,
right.
We're down at a pretty long-term support level. Bonds are down like 29%, I think, from the highs after COVID, the spike highs.
Yeah.
People are looking for that bond replacement. Like, where do you go if both are crashing? What are you supposed to do? And that's one of the plays as a passive investor. One of the plays is you don't own anything. If everything's falling, there's no point in holding it. And I think that's where I really differ from a lot of individuals. Is people always think they need to be in trades. They have to own multiple stocks. They need to trade a lot. They have to hold equities. My philosophy, it has been this forever, which is if something's falling, I don't want any part of it. I would rather watch it fall and get back in later. And so this, a bond replacement is cash. That's one of them. I mean, it's not very exciting, but I would much rather sit tight and see my money just hold its value than lose 15%, because bonds have been, a defensive play in the past 40 years, but we've had 40 years of declining rates. Rates kind of hit zero pretty much, and now they're on their way back up. So bonds are going to be under pressure. When you look at the big picture of bonds, this is the weekly chart. We go way back here. I mean, this is a pretty high volatility. You could argue it's a huge double top. It's on the verge of breaking down. Yep. I mean, if bonds break down from here and really start to head way down here, there is going to be so much pain inflicted on, baby boomers, seniors. It's going to be devastating. That's why people need to take action. It's not about what asset do you buy? It's really protecting your capital. And if there isn't anything, it's either cash or an inverse ETF if you're active in the market. So it's really important, this tipping point in this market.
Fed is playing with fire here. And again, you can see, bonds are back to where they were basically in the fourth quarter of 18. Mm-hmm. And we know what happened then. So that's good heads up. And like you said, there are times when, though we don't like fiat currency, that could be one of the best. Pull up that chart of the dollar, if you would. Yeah. This is not like an original thought. You can see what's going on here. The yen is going in the toilet. The euro is going in the toilet. Pound is going in the toilet. Makes the dollar look pretty strong. And as you can see, those are 20-year highs in the dollar index.
And we could see another huge move. I have a feeling we're going to see 16120 on the dollar, and that's going to put pressure on commodities, going to put pressure on huge multinational companies. Their services are going to be so expensive compared to other currencies. All this stuff, there's such a huge shift in what's going on. And if you're not on the ball, it can be really painful. And what's interesting is, I'm based in Canada, and, watching the US dollar rally is really good because I have a large chunk of my money in the US dollar. It's been in a strong uptrend for a while. And the dollar to me is cash. So when I just sell all my stocks or commodities, I move to US dollar cash in my account. Yet you watch the US dollar and it rallies. So cash is a very good play, especially for international players. And that's one of the reasons why I think we're seeing the dollar move up, is all the other currencies are falling. So what is an international investor going to do? They're going to move their cash to the best cash, which is the dollar.
Yep. So. And just, maybe by a month from now, this will all have walked back from the edge, right? And the dollar will be back down under 100 when we'll talk about how, we were worried about it going to 120 just a month ago. Yeah. But the point of all this for everybody watching, this is a time to be paying attention to all of your investments, not just your precious metals. Because there are ripple effects of all of this globally if we continue. So let's, in our final minutes, Chris, we should at least update. Let's start with that silver chart if you've got it. I remember in May of 2017, we watched, because really what more can you do besides laugh? Silver went from 19 to 15 by going down 18 days in a row. And the RSI, the momentum indicator of RSI, got to 18, and we laughed. This is now like a new adage at TF Metals Report. If the RSI is the same as your losing streak, that's probably a good time to buy. All right, so since all that optimism 3 weeks ago today, this is our 15th red candle in a row.
Yeah,
with no end in sight.
Let me flip to the daily chart, and it's just a bloodbath. I mean, it's just brutal.
And can you pull up? Do you have an RSI or a momentum indicator you like? So I mean, look at all those red candles. It's just, it's like, you know what? No one needs silver ever again. So there's just nothing left but people selling. But you can see we're at this area. People can see on this chart, we've come down here multiple times while we've been flagging sideways for the last year and a half. Held support near 22, even dipped down on 2 daily occasions below 22, and then quickly reversed. But again, Chris, that doesn't mean we're going to reverse this time. What are your thoughts?
Yeah, what scares me is silver's led the charge to the downside, and we draw that horizontal line. You know, it's right down here flirting with a breakdown. And the part that scares me is this looks really good. It is a support level. It's oversold. We got panic in the market. So it's naturally good. But what scares me is you go and you look at gold, for example, and gold for the equivalent kind of price action, gold would need to be like, you know, down here or down here. And we are a long ways from getting to those levels. And when you look at the gold miners like GDXJ, you know, it would be silver's equivalent to trading right down at these lows here. So miners and gold are just starting to break down. They're trying to play catch up to silver. Yeah. But if these things keep collapsing, silver could just slice right through support. It's going to create a very sharp wave of selling and panic, and probably another very sharp drop. I do think it'll be a great opportunity to pick up physical metals. I mean, this is the grand scheme of things, the big picture, you know, the quarterly charts of miners or metals. I mean, still very, very bullish. And I think there's a good scenario for a lot higher prices in the future. But I mean, I think we're still in for some more downside, and silver, if we're lucky, is going to hold its ground here while the other ones kind of catch up. So we'll just have to see. As you said, silver, within the last 3 weeks, broke its 50-day moving average first, and then gold and the miners followed. Then it broke its 200-day, and then gold and the miners followed. That's the thing. We'll have to watch it closely. Is there even on the silver weekly chart, Chris? One of the things I even wrote about this in my annual forecast. Again, you can still find it. Sprott Money. I said the first 4 months are going to be tough, a lot like last year of this year. We're going to be tough. And there's a gap on the chart there, at least on some weekly charts. There's a gap in there around 1975 or $20 from July. Yeah, right in there. Yeah, it would probably be if I go to the SLV, which will show probably regular trading hours. Yeah, maybe see that there's maybe one of these. I've always been concerned that we are open to a plunge down in there, and so we'll see. Again, we're so oversold already. Doesn't mean we can't. I mean, there's nothing to stop us going down 15 more days. I mean, the chart's just the chart. But gosh, we are so oversold already. There's probably an opportunity here. The old adage that you and I have talked about before with the precious metals, got to always be able to sell some when things look the best, like they now did 3 weeks ago. You also got to be ready to buy some when things look the worst. And we're getting close. For sure. Yeah. I mean, you look at the daily chart, silver, gold, miners were on a tear. I mean, they were a very good defensive play. But they just reversed. And this is where position management comes into play. If you're a short-term trader, you know, getting stopped out absolutely sucks. No one likes taking a loss. Right. Problem is, if you don't do it, it can hurt so bad. I mean, it only takes one bad trade to wipe out a good chunk of your wealth. Right. And that's the issue is everyone was on board. Even I was liking precious metals and miners, and it was looking like it was ready to take off. And the market reversed and it sold off. And if you didn't get out, you're underwater huge. And if this does break to the downside, it's really going to hurt because the silver miners, move a lot faster. Silver miners are down, 6% today, and they're kind of right down to these lows already.
Yep.
And they could very easily go a whole lot lower. So it really is about, cutting losses, managing your plays going forward. Because if the dollar does make that big rally, it might really, put a stall in precious metals and see them correct for potentially another several quarters or so, a long time. All right. It's
well, and again, the ripple effect of that, not only across, the central banks, but the emerging markets, the soaring dollar, like you said, commodities.
Yeah.
And again, the Fed wants to think they've got all this under control. But we're going to find out. We're probably not far from them having to cry uncle. They might want to talk like Bill Dudley saying they want to inflict pain, but they've driven so many institutions and endowments and pension funds and everybody else into these risk assets with their low interest rate policies over the last decade.
Yeah.
That man, they are really playing with fire here. So, Chris, as we wrap up, tell everybody a little bit about what you do on a daily basis, because I think we've made the point here that this is a time that people need to be paying attention.
Yeah. So with the technical traders, we offer kind of three different levels of ETF trading. One of them is the technical investor, which to me is one of the most critical pivot points in most people's investing lifetime. If you can avoid or profit from a bear market, I mean, it's going to set you light years ahead in terms of your retirement age or wealth level or both. And so that's what I help with, is kind of the big. Right now, I want to focus on the big picture, because there's majority of investors are, baby boomers, the older age. No one should have to suffer through a 3, 5, 10-year bear market and lose 30 or 50% of your wealth. And that's what I'm trying to really focus on over the next, this year, because if it's not managed properly, it's really going to hurt. So I focus on long-term investing signals. I trade them. Followers, the subscribers, they follow them as well. But I also get down into trading more consistent index and sector trading with the band trader, which is the best asset now, and our technical index and bond trading strategy. It allows you to get in and out of this market, profit from pullbacks and rallies. And so that's what we try and do, is we just try to navigate through this market to create that consistent kind of growth over the long run, so you don't have to hold through a bear market. There's nothing better than watching the market collapse and your account keeps going up quarter after quarter after quarter, or just simply avoiding it if you don't want to get active. You just want to be a couch potato investor and say, you know what, calling my advisor, I'm just going to move to cash. And, when technical investor tells me to get long in 8 months, I'll go get long at a cheaper price. Like, there's a lot of different ways you can attack the market. And so that's what I try and let everyone see. There's a million ways to invest, and you just find the way that works best with your style. And I kind of walk you through it and teach at the same time.
What's at the top of the list? Best asset now, right? Cash?
It is. Yeah.
Yeah. That's not surprising.
Yeah. The US dollar index is the place to be. Either UUP or just US cash sitting in your account. That's
there you go. TheTechnicalTraders.com. Chris Vermeulen, one of Eric Sprott's favorite technical analysts. It's always fun to hear from you every month, Chris. And again, we'll see where we are by next month. Things have certainly changed really quickly in the last 3 weeks. They could turn around and change just as quickly over the next 3 weeks. But in the meantime, if we do see a further dip, use that to your advantage. Go to SprottMoney.com. Always be looking for deals there. They always have very competitive prices. And we get that pullback. That might be your opportunity to add to your stack. Again, SprottMoney.com, or of course, just pick up the phone, give them a call, 888-861-0775. Chris, thank you so much for your time. This has sure been interesting, and we'll see where we are in June, huh?
Sounds great. All right. Thanks, Craig. Take care.
And thanks for everybody for watching. We'll talk to you again next month.